Hi, this is Jim Cunningham, and we're going to talk about LLC versus corporation. Which is best for your business? I'm doing this from Hawaii. We're going to cover LLCs, which is a limited liability company, and a corporation. It's kind of a little bit of a battle here. Which one's best for your business? And it depends on what the business is. And I want you to think of your businesses as two kinds of business. Maybe one's real estate, another one is an active business. Maybe one's more of a passive activity, one's more of an active activity. Meaning, if you're buying and selling things, that's active. If you buy a piece of property and rent it out, that tends to be more of a passive activity. So that's kind of the fork in the road, and we'll talk more in depth about that. But really, what fits your needs? And everyone's needs are different, right? So you might be concerned about asset protection. You might think, wow, this particular activity could subject me to liability. How do I mitigate that risk? How do I segregate that liability to a different entity, or keep it over here so my other assets are protected? And what about tax savings? There are a lot of ways to structure an entity, a business, in a way that has a more favorable tax outcome. I'm Jim Cunningham. I'm one of 10 lawyers at our firm, and we handle all things trust and estate matters, and basically kind of for wealthy people and business owners. You can kind of think about that. We don't handle family law cases or car accident cases, anything like that. If you're watching this on YouTube, we're doing this live, but we'll release this on YouTube later today. You can go ahead and click the subscribe button, and that'll pop up in your feed. We release these about 6 p.m. Pacific time, pretty much every week. I'm a lawyer. I'm talking. Words are coming out of my mouth. This is absolutely not legal advice. I view this as an opportunity. All these technologies came together during COVID, and that's when we started doing these webinars. But we live in this great era where there's so much to learn, so much to know, and it's so much easier to learn than it used to be. So what is a limited liability company? What is this thing? Well, an LLC is a new kind of entity. We used to have corporations. We all kind of always had partnerships, right? Going back thousands of years. Corporations were kind of invented in the last 400 years or so, 300 years. And then there was this new thing called a limited liability company. And a limited liability company solves the problems that a lot of times a corporation has that we'll talk about, and a lot of the problems that a partnership has. So think about this. Corporations have shareholders, LLCs have members. The owners of those LLC LLC shares or units are called members. And really kind of you could call them shareholders, but it's kind of confusing. So if you see member, right, it's going to be something attached typically to an LLC. It's not quite a member at a country club, right? But it's a member of an LLC. And any entity or individual can be a member of an LLC, except banks and insurance companies. So there's this kind of limitation there, which is an interesting exception. And the LLC, it's actually very easy to file and create an LLC in most jurisdictions in the United States. When I mean jurisdiction, I mean state. You can go online, set up your LLC, follow the prompts, not a lot of money, poof, you have your LLC. Well, that's just the beginning. That's the easy part. The real work, quite frankly, is in crafting the operating agreement. And the operating agreement is kind of like the bylaws. Now, what's interesting is an LLC typically does not require an operating agreement. You don't need an operating agreement. That's how simple this can be. But I would say best business practices, you're going to need an operating agreement because you're going to have to open a bank account, right? If you're running a business. So the bank is going to want to see your resolution that the LLC is authorized to open the bank account. And you'll see terms in there like members. Well, those are the people who own the shares. Managers, those are the people who obviously manage. LLCs can be member managed, meaning the individual members are the managers, or they can be manager managed. And that means that there's a manager who's different than the individual member. So you might see that if you're looking into this for yourself on an LLC. We do need to talk about capital contributions. That is, what are people putting into an LLC? If I go into partnership with Abel, and Jim and Abel create this LLC, and I put in $10 and Abel puts in $90, we might still split the profits 50-50. We don't have to, right? But then when we remove our capital, I get 10 and Abel gets 90. So that's an example of a capital contribution. And you can have meetings. They're not mandatory. It really depends on the context of the LLC. You should maintain good records, certainly for tax compliance purposes. And And indemnification, meaning if you take an action on behalf of the LLC, that the rest of the LLC members, and if I'm a manager of an LLC and I take an action that results in a liability, I'm able to go back to the other members and say, look, I was acting on behalf of the LLC. And so you guys all have to kick in some money. So that's an example of indemnification. Well, the real advantages of an LLC are many. I would say number one, you do have asset protection, right? Your membership units that you have in this LLC are protected from the liability is limited to those shares, right? Your capital contribution in the LLC. That's kind of the idea. Now, I will say that California is a little bit different because if you're part of an LLC and something goes wrong, many times you can be held personally responsible because California is probably the most creditor-friendly jurisdiction. You do not have to use California as the jurisdiction for an LLC. You are free to use another state. That's kind of a topic for other webinars, but here we're kind of highlighting the difference between LLCs and corporations. But you're always responsible for your own negligence. You got to remember that. Certainly fraud, all that stuff. Anything you do, you're going to be personally liable for. But really what we're talking about here is if you contribute $100 to an LLC and the manager goes off the rails and does something, your liability is limited to your capital contribution, right? Your liability is limited to that $100. That's really what I'm talking about here. LLCs are flexible. And then I would say this is the chief benefit of an LLC, the chief sort of attribute where people say, wow, an LLC is a really good alternative to a corporation because you're very flexible on how you can run these LLCs. Again, you don't have to have an operating agreement. You'll see that a corporation does require bylaws. You don't have to have annual meetings. A corporation has to have annual meetings. And you have flexibility on distribution. So you can agree to distribute differently. I mean, that's kind of cool, right? There are fewer corporate formalities, as I mentioned, and tax benefits. And this is really probably the single biggest benefit tax-wise, if you will, is like income tax, right? And we'll talk a little bit about capital gains tax and LLCs, but really the chief benefit is an income tax benefit. And I'll show that in a couple of slides. So an LLC, first of all, a corporation must be taxed as a corporation. And a corporation cannot be taxed in a different way. A partnership must be taxed as a partnership. The LLC is in this middle ground, and you have several options on how you can have this taxed. So I would say the most, a very common structure, if it's one person creates an LLC, that's called a disregarded entity. Now, if this is new for you and you're like, well, I've never heard of disregarded entity. What are you talking about, Jim? For federal purposes, this LLC does not file a separate federal income tax return. So for example, if I create an LLC and maybe I'm selling lemonade off my front lawn, okay, I can create an LLC and that LLC can sell, Lemonade LLC can sell lemonade to people as they drive down the street. The income that comes in is reported on my own 1040. I'm the sole shareholder. Okay. I'm the sole member. I'm the sole owner of this LLC. And that money flows into the LLC, and that money is reported federally on my 1040, which is my individual income tax return. I do have a state income tax return that has to be filed. So if it's a disregarded entity, you're still filing a state return. I would say this is probably really a very common structure. We use it a lot in different contexts, okay? And one real benefit, of course, is you can pay if you have two members of a disregarded entity, and this is kind of weird to get your head around. So my wife and I in a community property state can own these shares 50-50, Jim and Lori. Our disregarded entity under California law can pay the tax at the corporate level at a flat 9.3%. And that's saving 4% at the marginal rates. And that is deductible federally. So we have covered this on a lot of other webinars, but that's called AB 150. And if you're watching this, and you're like, I have no idea what you're talking about, but I feel like I pay way too much in tax. There are ways that you can structure your businesses and your investments in a way to deduct your state income tax paid. Because you remember that SALT cap under the 2017 Tax Cuts and Jobs Act took away or capped it at $10,000. An LLC can also be taxed as a partnership. Oh, one thing is that California does have a gross receipts tax, meaning the minimum is $800. So to have an LLC, even though you have $1 in income, you're going to be paying $800 in minimum franchise tax. LLC, disregarded entity, that's going to typically be an individual person or maybe a couple that own it as community property. This only works in community property states, does not work in separate property states. So if you're looking at an LLC and you're in Idaho, you're married, you're probably going to be taxed as a partnership. Okay. A partnership does require a separate filing, a 1065, meaning you have to file federally this form as well as another state income tax return as well. So this is also common for real estate, right? Real estate, we see disregarded entity. We also see partnership structure for reasons that we'll talk about a little bit later. And then you still have your gross receipts tax. What am I talking about? Well, what I'm talking about is, look, if you're going to have a piece of real estate, right? Should you put it in an LLC or should you put it in a corporation? An LLC is going to be better because it can be taxed as a partnership. One really big attribute of the partnership is that when one spouse dies, if it's community property, the surviving spouse gets a full adjusted cost basis. So what that means is if you buy a property for $100,000, it goes up to $1 million, you fully depreciated it, right? You may have a huge gain if you go to sell it, but if one spouse dies and that's community property, you make your 754 election on your Form 1065 and poof, you get an adjusted cost basis. Then you can sell that property for $1 million and not pay any capital gains tax. Pretty cool. That is not true for separate property states. So it's one reason if you have a lot of low basis property and one spouse is going to die, you might want to think about moving to California. Taxed as an S corporation, LLC taxed as an S corporation. This is an election that you make when you create the LLC. In California, California does have a tax of 1.5% on basically your corporate profits, for lack of a better term. We do not recommend this for real estate. You do not get an adjusted cost basis at death when a property is owned by an LLC that is taxed as an S corp. Okay, that underlying property that's in the corporation does not get an adjusted cost basis, and that's a kind of a big deal. It does require a Form 1120S, which is your corporate return. You don't pay federal corporate tax. That's paid on the individual shareholders 1040, right? The individual members 1040. And again, we don't recommend this for real estate. Some people have legacy corporations, maybe farmland, maybe grandpa bought some farmland in the 1940s in a corporation. Well, that might have been your only option back then, right? Because we didn't have LLCs, we didn't have S corps, we didn't have all this stuff. And if you're in that situation, there are things that you can do over time. Typically, it's a 5-year time period. There are things that you can do over time to optimize the tax outcome, quite frankly. And that's something we help clients with. So taxed as a C corporation, I would say this is very uncommon that an LLC would be taxed as a C corporation. We don't really see that. You do file your federal Form 1120. It is subject to state, federal and state corporate tax. And again, it's not recommended for real estate in most situations, right? I would say this webinar is designed for kind of individual people who are going out and buying real estate and they go, should I buy an LLC? Yes or no? Well, yeah, you think about an LLC. Should it be taxed as a corporation or a partnership or a disregarded entity? Yeah, you probably want to avoid the corporation. Again, every situation's different. You need to talk to your advisor. So in most cases, LLCs don't pay income and capital gains taxes on their profits directly. So this would be if you're a disregarded entity, an S corp, or a partnership, right? These profits pass through to the members and they report them on their individual returns. And in California, unless it's taxed as an S or a C corp, you are subject to this $800 minimum franchise tax. And of course, if you have gross receipts of $5 million, then your minimum tax is $11,790. Now, this is gross receipts. This is not profit. This is money that comes in, it's deposited in your bank account. So pay very close attention to that. What is a corporation? We talked about LLCs. Let's talk about corporations. Corporations in general, owners are called shareholders. Corporations have rather rigid corporate formalities, and these really do have to be followed. There's something called piercing the corporate veil. So if you say, hey, I'm going to set up this corporation, I'm going to invest some money, and this other person's going to go out and do some stuff and make some money, and I want to limit my liability. If they're able to pierce the corporate veil, they're able to come after you individually. So you do have to follow the corporate formalities. Yes, you do. And if you're thinking, uh-oh, I have this corporation, I haven't done my meetings for 10 years. Yeah, you should have done those, right? You need to do those annual meetings because that's one of the requirements to keep in good standing as a corporation. Corporations are governed by bylaws. In addition to the California Corporations Code, they're governed by bylaws. And these include provisions for shareholders. How many shares are issued? Who are the directors? Who are the officers? What if there's a vacancy in the office of president or CEO? What happens? How do you create a meeting? When are the meetings? What is the notice requirement on the meetings? Where are the stock certificates? You have to issue stock certificates in a corporation. And indemnification is, if a president is acting on behalf of the corporation and kind of messes up, that president's covered by the corporation. Now, I will tell you that the basic structure on a corporation is you have shareholders. Now the shareholders own the equity you can think of in the corporation. They own the shares of the corporation. So this corporation is this thing, it's an entity that has title to property, for example, or owns a business or is running whatever it is. These shareholders own shares in the company. So they're the true owners of the company. The shareholders vote in directors. Now the shareholders cast their vote and they say, we're gonna vote these people in to be the stewards of our shares in this company. And then the directors appoint the officers, and it's the directors that hold the officers accountable. The shareholders can sue the officers of the corporation, but really if the shareholders want something done, if they want to change in the makeup of the officers, the president, the CEO, the treasurer, the secretary, they really should be, or they often have to go through the board. So the shareholders might have a vote in new members of the board of directors, and then that board of directors takes that action. So you can see it's a little clunkier, a little more complex than an LLC, which is the members vote the managers. Hey, we don't like what you guys are doing, managers. We're going to vote you out. New managers, poof, done. You don't have to go through this structure of directors and officers. And it's very important to understand if you're watching this and you're in a state and you have a profession. So the states individually regulate professions. California, the California State Bar regulates lawyers. We cannot have a professional LLC. We have to use a corporation. So if you're a lawyer in the state of California, you have to be organized as a corporation. There's no such thing as a professional limited liability company for lawyers in California. That is not the case with other jurisdictions. Same with physicians. The same with real estate brokers, but not real estate agents. So there are some nuances here when it comes to professionals. And I would say corporations are frequently used for operating businesses. And I would include in this bucket an LLC taxed as a corporation, okay? So we covered that before, but the LLC taxed as a corporation is oftentimes used for an operating business. Anonymous asks, corporations sound complicated. At what point is it something I should at least consider? Dollar amount or question mark? Yeah, I mean, Anonymous, that's kind of the point of me going through this is when people say, hey, I'm going to do a business and, I don't know any of this stuff. Well, corporations are more complicated. Now, at what level? Well, I would say if you're a professional, you might not have a choice. If you're a physician, you might have to use a corporation. If you're a real estate broker, you might have to use a corporation. And it just, it really is case specific and it depends. And the other thing too is to look at the nature of the business. So if you have a lot of gross receipts, and not a lot of profit, you may find that a corporation's better. Anonymous asks, I own rental property in California in an LLC with my 3 other siblings. We each have 25% membership. What happens to my 25% share of the LLC if I die without a trust? Will my 25% membership automatically go to my heirs? Well, Anonymous, it really depends on what the operating agreement says, first of all. You may have, it may not, that 25% may not automatically go to your heirs. The other 3 people may have the opportunity to buy that back, right? The LLC itself might have the opportunity to buy that back. So you really need to look at the operating agreement. And I would say that if you have a 25% membership interest and that 25% membership interest owns real estate, it is probably over the jurisdictional limit of about $184,000. Probably is going to require a probate. So it's something I would certainly look into, but here's what I would do. Look at doing an estate plan, a living trust centered estate plan. Secondly, look at the operating agreement, see what it says. If there is no operating agreement, then the law takes over, right? California law dictates what happens. So you're better off to have clarity and have that written down what happens if somebody passes away. So there are 2 ways to tax corporations. There is the S Corp and the C Corp. So the C Corp is like Apple. Apple makes a lot of money. Whether or not they pay taxes is a hot political issue button, or how much they pay, I should say. But the idea here is like Apple has a lot of revenue, billions and millions of dollars. They pay some tax, okay? They pay some income tax. Now, certainly they're paying a lot of payroll tax and they're paying a lot of property tax, but they do pay this income tax on the corporate level. So let's say they pay $1 billion in corporate income tax. And then they distribute the dividend to the shareholder. The shareholder has to pay tax on that dividend. So yes, the money is taxed twice. Now, there are other advantages to a C Corp that we'll see here in a couple of slides, but by and large, understand that a C Corp is taxed twice. An S Corp allows for the income to flow through to the individual shareholder. So If I open a lemonade stand and I create a corporation, Lemonade Inc., and I get $100, that corporation is not paying tax on that $100. I put that $100 on my individual 1040. I still have to do a corporate tax return though, right? So how do you create an S Corp? How do you elect an S Corp? It's not automatic. You have to affirmatively elect an S Corp. And this is where people get tripped up all the time. And people say, I'm a smart person, I can do this on my own. I would really recommend that if you're going to do anything corporate wise, you really should talk to a knowledgeable person. Probably is going to be a lawyer. Sometimes it's a CPA, but really, I think the lawyer CPAs working together, kind of that part of that A team that we talk about a lot. It's a really good idea because you don't want to step in it. And what do I mean by stepping in it? If you set up a corporation and you do not make an S Corp election, meaning elect to be taxed on a pass-through basis, you will have a C Corp. Okay. So a lot of people, I would say this is number one common mistake. People set up a corporation, they don't file this form. So if you set up a corporation, I would check in with your CPA and say, hey, I set up this corporation because there's a deadline on this. So the S Corp has 100 or fewer shareholders. The shareholders must be US citizens or permanent residents, and trusts cannot be shareholders. This is very, very important. So if you have an S Corp and you want to put those shares into your trust, you have to have S Corp language in your trust. Now, it's something by default in our firm. Pretty much every trust that goes out has S Corp language in it to preserve the S Corp election. So there's a workaround on that, but it has to be written into the trust. So that's very, very important. If you have an S Corp and you have a living trust, you need to make sure that that living trust does not blow your S Corp status. Otherwise, it becomes a C Corp. It's pretty big penalty. S Corp taxes, these pass through to the shareholders. So they're all accounted for on the corporate return, and they ultimately land on the individual shareholders' 1040, their individual income tax return. California does impose a franchise tax of 1.5% or $800, whichever is greater. So if I have profits of $1 million on my S Corp and I take that as a distribution, not as compensation, but as distribution, a shareholder distribution, I'm going to pay $15,000 in taxes to the state of California. And you say, well, wait a minute, this is pass through. How come I'm paying taxes to the state of California? It's because it's the state of California. That's the deal, right? They're, every time you turn around, they're taxing you. So, but there are some advantages about being in California, right? Typically when people pass away in property taxes and other things, but it's a very taxing jurisdiction, as we say. Dividends versus salary. I think this is a really big, we've covered this in other webinars, and these are available on our YouTube channel. This I would say is really not particularly well understood by CPAs. I would say some understand it. But here's kind of the idea. Let's say I'm making $1 million and I can pay that. I'm probably paying, I don't know, $480 in taxes. And again, we cover this in other webinars. I'm paying almost $500,000 in taxes. If I pay my state income tax from my corporation, my $100,000 in state income tax, I'm paying it at a lower rate. Okay. Paying it at a flat 9.3% rate, not that marginal 13.3% rate or 12.3%, depending on the amount. If I pay that from my corporation, I'm able to deduct those state income taxes. I'm able to save federal taxes, about almost $40,000 in federal tax, just by having an S Corp, just by paying the tax from the corporation. That's AB 150. Well, then instead of maybe I take $100,000 compensation because I look and the role, selling, running a successful lemonade stand, I would have to pay a manager $100,000 a year. So I pay myself $100,000 a year. I take $900,000 as a dividend, as a distribution, not as compensation. I avoid the 3.8% Medicare tax. I do have to pay the 1.5% California income tax. I'm also saving 15.3% on that 100,000 to about 160,000. That's because up on earnings, if you're a sole proprietor, on earnings of up to 160,000, you have to pay self-employment tax. And that's 15.3%. So that'll save another, I don't know, what is that? $10,000 in tax. So I'm net ahead, 20, 30,000 in tax. Again, we cover this in greater detail in other webinars, but this is very important to understand. If you're making a lot of money and you feel like you're paying too much in tax, and I know I didn't even put numbers on those in terms of what you're making or how much you pay in tax, but if you feel like, wow, I'm overpaying on taxes, in many instances, there are things that you can do that literally shuffle the deck and you end up paying less tax. So these are things you could certainly reach out to our firm and we can help you with. And these are things that a CPA can also help with, and we work in conjunction with them. But what I would do is I would run, before you elect your S Corp status, you should run an economic modeling. I would say in most instances, you are going to be taking some as a dividend if you're a high income earner, sometimes not. The other thing about an S Corp that we cover in other webinars is you can save more in retirement. And that's a really big deal. So you're kind of limited if you're a sole proprietor, what you can save. And if it's a corporate entity, you can actually save more, like in a 401k or an IRA or a SEP or those type of savings vehicles. Richard Campos says, is there something about a 35% tax rate for corporations? Yes, that's professional corporations, Richard. So if you're a professional corporation, it's a flat 35%. It's a big deal. How much is too much to pay on taxes? Anonymous, great question. I don't know. It's a feeling, I don't know. I'm just asking, hey, if you feel like you're paying too much in tax. C Corps can be great tools for complex businesses or businesses with foreign shareholders. I mean, there are reasons to have a C Corp. And I would say probably the single biggest needle moving reason to have a C Corp that I see now, I'm a little bit biased, even though I'm in Hawaii right now, trying to be on vacation. I do live in Northern California, and there are a lot of tech and software companies and startups and web 3.0 people or whatever it is. There's a lot of tech, and a lot of times they use the C Corp structure because there's something called qualified small business stock. This allows you to invest in a startup, and you can exempt $10 million in federal capital gain per year per taxpayer. Okay. And it's also excluded from the 3.8% net investment income tax. This is very, very important to understand. California does not follow qualified small business stock. So what am I talking about? Many of our clients invest in a tech firm. They might invest $100,000 and they get $1 million back, let's say. They're not going to pay federal capital gains tax on that $900,000 gain. They will pay state income tax, right, on that $900,000 gain, but that comes in tax-free if it is a qualified small business stock. And so a lot's been written on this. It's kind of outside the scope of what we're talking about, but I do want to say that if you're looking at creating something and taking advantage of qualified small business stock, it's a very powerful tool. Many of our clients will end up, if they're California residents, they will end up putting that property into, or that qualified small business stock into what is called a non-grantor trust. Now, they might cite that in Nevada. And the advantage there is at least you're delaying the payment of income tax. So it's a workaround. But many people, frankly, they end up leaving California if they really don't want to pay that big tax bill. If you're getting $10 million, it could be, it's $1.2 million in state income tax. Yeah, it might be a reason to leave California for a few years. So just personal preference. C Corp advantages, liability protection for shareholders. I would say this is probably, in looking at corporate forms, this is really powerful, right? Because if you invest money, let's say you invest $25,000 in a startup and the thing goes south, you don't want to be on the hook for all those debts. And a C Corp protects you, right? The officers can be liable. The officers, right? The people who are signing the contracts, but you as a shareholder are not liable. And you can access the capital markets. All these companies that you see traded on Wall Street, all these, non-REIT real estate investment trust companies, they're all C Corps, right? There's no S Corp out there because there's no limit on the number of shareholders. Remember, with an S Corp, you're limited to 100 shareholders, and getting out is really easy. One of the great things about our country is we essentially created this free flow of capital market where if you want to unload 1 million shares of Apple today, yeah, you can do it. It's because we have a liquid market. And I would say that's an advantage. You're not going to be held up for a period of time or whatever it is. So there are some real distinct advantages with C Corps, but it's more on really the investment side for most of our clients. Disadvantages, setup time requires time and expense. This is a tough one. If you do a C Corp, you really have to pay attention to your bylaws, and a board of directors absolutely should be appointed. Shareholder agreements are really paramount. I would say a C Corp is sort of ratcheted up in terms of its complexity, right? And typically the numbers are bigger. There are more zeros on a C Corp than an S Corp. And following the corporate formalities, very important. Otherwise, you might end up with a shareholder suit, right? The shareholders could sue the board or the officers. And you absolutely have to follow the regular meetings. And you have this issue of double taxation, which, the corporation pays tax and then the dividends, right? You get to pay tax on the dividends. So that would be the downside. In California, the taxes are paid on a flat rate. So it's 21% federal tax and 8.84% in California. So almost 30% in California. Remember, there are always state income taxes to deal with. And there is a proposal to raise that to 28%. So we'll just see what happens there. But again, you have to pay tax on your dividends. So C Corps, pretty complex, bigger companies. LLC versus corporation. Well, which is better for you, right? When not to use an LLC. Professionals can't use LLCs in California. Physicians, lawyers, accountants, real estate brokers must use the corporate format. It's a professional corporation. And again, this differs from state to state. Another state may not be the same. If your gross receipts are high and your margins are small, let's say you run a grocery store, you might have 5 million in gross receipts and make $100,000 profit, right? You might want to reconsider use of an LLC because you do have this gross receipts tax of $11,790. And if it's more than 5 million in gross receipts. So, and that's regardless of your profits. So when weighing this, you might be better off with, with a different entity, with a different form, right? But again, run this economic model before you choose your business structure. And when can you use an LLC? I met with a client recently, and for independent contractor services, and California is a little bit different because pretty much everyone's an employee in California. But I did hear from a client. He said, yeah, I do consulting for big companies, and they really didn't want me to do this individually. They wanted to pay me through an LLC. So I see that as kind of a trend. And in that instance, that particular client had that consulting business, that consulting gig, taxed as a disregarded entity. We are looking at having it taxed as an S Corp. But, is the juice worth the squeeze? If you're making $50,000 a year, I'm not sure it's worth it. The cost associated with setting up a corporation, unless you have to, if you're a professional. But if you're making $1 million a year consulting, you might be better off with the S Corp because you can avoid some of that self-employment tax and the Medicare tax, the 3.8% Medicare tax. So again, very individual. This is something, you measure 19 times and cut once. We also don't want to make a 19-course meal when all you need is a ham sandwich. So there's a balancing that goes on. And really, lawyers and other professionals, fundamentally, we have time, and that's what the lawyers and other professionals are selling. And that's why lawyers, frankly, bill by the hours, because that is what kind of makes most sense in most contexts. So running a small business, I would say you could use an LLC, management of personal investments, taxed as a disregarded entity. So again, you may have investments. You say, look, these are all in my individual name. Maybe I'm spending a lot of time on this and I want to make it an active trader business. There's some tax advantages on that. You may want to put those into an LLC. And certainly real estate investing, taxed as a disregarded entity or partnership is typically what we see. We've covered this in other webinars. We also have a holding company structure. So if clients might have 2 properties in California, 2 in Texas, and 2 in Florida, and many times we'll do a holding company in Wyoming. And that way we really are kind of buttoning down all of the liability because again, you're liable for your own negligence. And sometimes, if you own these LLC shares and something happens in California, those LLC shares can be taken away from you, right? So if I have an LLC and I put a piece of property into a California LLC and I do something that generates a liability, my creditors can come after my LLC shares, okay? And what that Wyoming LLC does is that sort of addresses that issue and puts a wrapper around the individual shares and makes them harder for creditors to access. So we've covered that in other webinars as well. That's a Wyoming close LLC. So real estate investing, really great option for the LLC. And independent contractors. Again, we see them if it's a small amount, if you're making $20,000 a year, $50,000 a year, I'm not sure it's worth being taxed as a corporation. You do have the corporate return. For most people, I see them on a consulting arrangement, they will have an LLC taxed as an S Corp. And then you take a salary, an appropriate salary. And that's something where, that's, and the Department of Labor has statistics on that, what the appropriate salary would be. And then anything above that you can take as a dividend. So the advantage there, of course, is you're potentially bypassing self-employment tax, and you're also bypassing the Medicare tax. You're also able to save more for retirement. And this is really key because if you're an individual, and we covered this in previous webinars, but you can save more with a corporate entity than you can without a corporate entity, okay, just on a very high level. And again, California professionals have to use corporations, not LLCs. And again, that corporation likely will be taxed as an S Corp. I don't know the last time I saw a professional corporation taxed as a C Corp, unless it was by mistake. But again, check with a savvy lawyer licensed in your estate. And LLCs for small businesses. I would say margins matter in California, because if you're running a business that generates a lot of revenue and a very small margin, you may not want to have the LLC because the gross receipts tax may be too much, and you may want to be taxed as an S Corp, right? You don't want to be taxed as a disregarded entity. But again, this is something you're going to need to check with your advisors before you set that up. And we've put in here a link to our webinar, Income Tax Reduction Strategies for Professionals and 1099 Earners. So we've covered this at length. And LLCs for personal investments, frankly, I don't see this as much as maybe we probably should, but these are where you're segregating or holding investments away from your personal assets. And this is where, if you want to start making gifts to your children, right? If you have 100 stocks in an account, you can move those stocks over one by one, or you can have your LLC and make gifts of shares of the LLC to your children, right? So if you want to start making lifetime gifts to your children, you can do that using the LLC rather than the shares themselves. And then, of course, that's one sort of overarching structure. And again, the benefits of the LLC: fewer corporate formalities and just a lot more flexibility. But again, the holding company, and we've covered this in other webinars, that's where you have a company like a master LLC and a bunch of other LLCs that might own individual properties. If you want to take advantage of the $12,920,000 gift tax exemption that everyone has, we will set that structure up, and the gift is made from that sort of master holding company rather than individually from the LLCs themselves. Now, that sounds like it might be over-engineered, but it actually results in fewer partnership returns being filed, depending on the individual situation. It's a very common structure that wealthy people use. So when should you get an LLC for real estate investing? I think it's personal choice. Some people have one LLC for every property. And in California, a lot of people don't want to pay that $800 minimum franchise tax. And I think that's the single biggest barrier. For residential, I would say it's recommended for asset protection to segregate that liability to that particular property. And that would be, when I say residential, I'm talking 1 to 4 units. And I would say it's recommended. I wouldn't say it's, you really should be doing it. If you have commercial property, office, retail, industrial, multifamily, which is 5 or more units, or ranching and farming, I would say if you don't have that in an LLC, number one, you might be leaving a significant amount of money on the table in terms of saving state income tax. But secondly, I just think those properties are too risky. There's too much activity going on. I think the single biggest threat to farmers and ranchers is fire. Fire starts in your property and spreads. And we had 2 clients over the years where big fires in Southern California started on their properties, and it was very stressful for many, many years. And it's just something. Fire is one of those crazy things. It can start on your property and it can just cause way more damage than you have insurance coverage for. And guess who's going to end up suing you? It's a bunch of insurance companies who pay out on the other policyholders. So, but again, multifamily, office, retail, we see in that context, many people have those properties in an LLC, not individually. Gives you asset protection and also accounting. You can borrow on the LLC level. A question comes up from time to time. People say, well, can I use a trust instead of an LLC? Not really is the answer, because an LLC can borrow. Banks really don't like to lend to trusts. So that's kind of where it gets a little dicey. And that's why you'll see when clients are gifting properties to children, typically they're going to put those properties in an LLC. So if you have a 50-unit multifamily and you want to give a 10% interest to your children, you're typically not just going to deed them 10%. You're going to have that in an entity and then make a gift of those LLC shares. So that would be a reason to put that wrapper around the multifamily. And I would say real estate investments, if it's an LLC versus corporation, the LLC is going to beat the corporation pretty much every time. I would say corporations are very easy to get into, and they take a long time to get out of. It is possible to do it. Sometimes it can be expensive in terms of extra taxes. But I would say if you're going into a property, if you have a property that you're going to put into an LLC or an entity, or you're going to buy a property, really look at the LLC, potentially a partnership. We really didn't talk about partnerships. That's kind of been subsumed in the LLC. A limited partnership is what we used to do before LLCs were invented in California or before that legislation was passed. That is even more complex than a corporation, quite frankly. So we didn't really even talk about that. We don't see it that much. Real estate and corporations really don't play well together. And I know I'm kind of beating this one quite a bit, but it's generally a really bad idea. So there are a lot of problems that go with this. So when you move property in and out of a corporation, transferring appreciated real property into a corporation may cause a recognition of capital gain. If it's a partnership, it doesn't. So it's very important if it's taxed as a disregarded entity. So don't just willy-nilly transfer, don't just set the stuff up and transfer it. You may find yourself in a really tough spot. And if the corporation takes or assumes debt on the property, that may trigger a capital gain, right? So a lot of special rules. Transferring property out of a corporation can be a taxable event, and the corporate taxes will be higher, 21% on the corporate level, and then the shareholders pay. This is on a C Corp, and then the shareholders pay the tax when they get the money, and no adjusted cost basis at death. It's a big deal. So you get new basis in your shares, but not the underlying property. So it's very tricky situation. I would say there's care and feeding. It's required for your business entity. You've got your CPA, your tax advisor, your certified financial planner, and your estate planning attorney. I would say that you might have a fourth leg in there, which is your real estate professional as well. So broker or agent. So all kind of working together. And business entities do require maintenance. These are not just set it and forget it. You typically have professionals involved. And really the lawyer in many instances is the project manager, because the lawyer has many times the broadest knowledge, and lawyers are in the habit of managing projects. So we open a file, we have deadlines, we have calendaring software, we assign things to people and we follow up. This is just kind of how law is practiced. And that's not necessarily the case with all the other professions, certainly some of them, but not all of them. And I would say if you're going to have an entity and you're going to own property over the long haul, I would say prepare yourself for a lengthy and deep relationship with your advisors. And I will say that when clients come in or potential clients come in, that's something we really think about, because I deal with many of my clients for decades. Not all, but many times these are people that you have a very long relationship with. It's very important to have advisors with succession plans. We have a succession plan in our firm, right? If I don't show up at work one day, or I don't know, get hit by an ice cream truck, then the firm will carry on, because we do have other people who would be taking it over. So very important. And that's one limitation. I think you say, well, I got this great guy or this great gal, they're a solo, they know everything, they help me. Well, what happens to you if something happens to that advisor? And I think it's something really to think about. Certainly as we age, I know it's something I think about a lot more than I did when I was a young lawyer. What about not registering a business entity? Hey, what if you just say, hey, I don't want to deal with the state. I don't want to deal with all this stuff. You can be what is called a sole proprietor, where you get a lawnmower and a pickup truck and you start mowing lawns, right? You're conducting business without forming a business entity, right? You can do that. A general partnership. It's kind of like if one sole proprietor and another sole proprietor kind of look at each other and say, we need to go into business together, right? That's a general partnership. Now, whether you want it to form or not, that's a general partnership, okay? You don't have to file. And this is like two sole proprietors coming together to work together. That is a partnership. And they can be registered with the state of California. They're not required to be registered by the state of California. So you won't have an entity number. I would say there's no liability protection, and little credibility when it comes to business, right? If you're just, Jim and Bob's lemonade stand, there's not a lot of credibility, right? And then all these state default laws apply. So there's California has a corporations code, all those rules apply, and you haven't been able to craft an agreement to sort of mitigate the worst parts of those. And I would say getting out of a partnership can be kind of tricky, right? It's a little bit like a marriage. And partnership taxation, probably the most complicated taxation next to Prop 13, right? The most complicated tax topic that there is, partnership taxations. And partners also have fiduciary duties to each other. So this is really important. So they have to put the interests of the partner before their own, and joint and several liability and personal liability. So 100% personally liable. And bonus tip, make sure your living trust has S Corp provisions, even if you don't have any S Corp shares, okay? This is a few pages that goes in there. And I will tell you, I have had instances where people have passed away with S Corp shares. And I was we didn't write the trust. And the trust was about 25 pages long. And I was at like page 22 and I started sweating it because I said, I don't think there are S Corp powers in here. They were at the very end, thankfully for the client and more thankfully for the company, because that would have made some very unhappy shareholders. So very important you have these S Corp provisions in your living trust, even if you don't have an S Corp. And here's why. You may inherit S Corp shares. You may invest in something that later becomes an S Corp. You may invest in some type of activity that is an S Corp and you don't really know, right? So it's just good to have in there. It's kind of like when you go on a vacation to a tropical location, you take a sweater. Why? I don't know. You take a sweater, you might be in a place that has a lot of air conditioning. So this is sort of the take the sweater on the vacation analogy. I would recommend that if you have a living trust, you consider having these inside of your living trust. And that may result in back taxes if it's not in there. Get an A-team, get your lawyer, CPA, financial advisor. They form the three-legged stool. And that's something that we love when we have a client and we have a great A-team. We can do so much for the client. Many people ask us, hey, I don't have an A-team. Can I get an instant A-team? The answer is yes. So we can certainly help you with that. We work with a few, not a whole lot, but a few great advisors. And we can certainly assemble an A-team for you. Our offices are located in Northern and Southern California and Bay Area, Capital Region, and the Los Angeles area. If you're watching this on YouTube, please subscribe to our YouTube channel. And next week, and if you're watching this on YouTube, you might have already seen it, reduce the employee retention tax credit hit. Employee retention tax credit mitigation. And you might be thinking, what the heck is that? Businesses got given a lot of money. So there was PPP and ERTC. So if your business revenue went down and you kept your employees, the government gave you a whole lot of money. Now, that is not taxable on state level, but you do have to pay taxes on the federal level. And we're going to go through what that process is and how maybe you can mitigate some of those taxes. And that's coming up on March 2nd. And we've got a link posted in the webinar and it should be in your notes. Can you share the slides for the seminar? These will be on our YouTube page posted here. And can you have a recording? Jim, great question. Jim, you can have, this will be posted on our YouTube page a little bit later today. It has been a pleasure to present this valuable information to you, and keep watching because there's another video. If you're watching on YouTube, there's another video that's going to start right now.